So today I'm going to show you 3 stocks that I'm personally looking at right now before February ends and why they might be some of the best values for disciplined investors heading into March. Now guys, the exciting part is I own all 3 of these stocks. Doesn't mean you should go out and buy them. We're here to teach a process, but even more important is as stocks I know and like go lower, I want to buy more of them. So this is going to give me an opportunity potentially to buy more of these. And I'm actually going to add a 4th stock as an honorable mention that I also own. Anyone can just tell you what they're buying. That's not what we're doing here. I'm going to show you what I'm buying, what I own, but at Everything Money, we want to teach you how to fish. If I just tell you go buy the stock, first off, not allowed. But second, if the stock falls and I don't make a video about it, what are you going to do then? I'd rather teach you how to fish so you can handle what to do and you can handle what to buy. I'm not showing you these companies because I hope they go up in the short run. I'm showing them to you because they fit my process and they look attractive today based on my assumptions about the far future. When I say long-term investor, guys, I don't mean the tax definition of long-term, which is a year. I mean 10, 15, 20 years. And all 3 plus the 4th honorable mention are companies that I want to own for decades to come. We do not follow hype. We look at the story, we look at the numbers, we put them together, and we figure out what we're willing to pay using our stock analyzer tool, because that's what real investing is all about. So in this video, I'm going to walk you through each one of these stocks. I'm going to show you the good, the bad, the risk, and the potential reward. Then we're going to run them through that stock analyzer tool, which is used over 1 million times per year by our users to find the price that makes sense. Because at the end of the day, investing isn't just about what you buy. Its most important aspect is what price you're willing to pay. Let me tell you a quick anecdote about this. And it's not about stocks, it's about real estate. I recently met with a real estate company, great company, very large. And they were talking to us about their real estate deals. They just transitioned from one real estate kind of sector to another that we're experts in, multifamily. And they were telling us about a deal they had that wasn't going well. Well, it turned out it was several deals not going well. But one of the issues were they were sitting there saying, well, going forward, if we look at this deal, blah, 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 we're going to be worried about the electrical and blah, blah. And I looked at the guy and I said, instead of worrying about these small little issues and small little things, you didn't worry about the most important aspect, the price you were paying. Because if you paid the right price, all of those other issues go away. You can afford to go pay that. The problem is you were paying a premium for something that also had a bad story. That's what we talk about with margin of safety. I always tell people, they're always worried about all these stories like what's AI going to do? What's this? Blah, blah, blah. But then they don't worry about the most important part, paying the right price. And the fact that everybody doesn't worry about that gives you a massive advantage. Now, as I repeat over and over, never buy a stock for any reason that anybody owns it, even if it's Warren Buffett. He has a different goal than you. I have a different goal than you. You have different goals than me. I'm here to teach that process so you can go buy the things that make sense for you. Let's look at stock number 1, American Express. Now, they're working hard to attract new, high-spending cardholders around the world and are focusing on building stronger digital tools to keep their users engaged. They also expect to make more money from credit card fees, which have already been growing a lot, big part of their long-term strategy. Analysts project Amex will grow its earnings by 12 to 16% in 2026, showing confidence in the company's plan to keep expanding. Guess what? I don't care what they're going to grow or lose in earnings in 2026. I care about, is this company going to be around for decades, and are they going to make considerably higher money decades from now than today? And the third most important thing is, can I pay a rational price today for that? So now we need to go run this through our stock analyzer to determine a price we would pay for American Express. So, $245 billion market cap, a lot of enterprise value. That difference is debt. Well, they're holding people's money. There's a lot of money out there, et cetera, et cetera. These credit card companies and banks tend to have this big difference. But like I said, $19 billion in free cash flow last year, selling for 13 times their free cash flow. Revenue growth. Guys, keep in mind, their net acquisitions in the last 5 years, only $500 million. For a $250 billion company, that's nothing. This is all this growth right here is all organic growth. 11.5% a year for the last 3, 13% a year for the last 5, 8% a year for the last 10. Has it been a booming economy? Yes. Our community holders, our community members have this as a hold. Now, 8 pillars. I'm not worried about the debt. PE ratio, significantly higher than the 5-year price of free cash flow. I don't really think this is I think this is actually an 8-pillar stock essentially. Yes, the debt is high, but it's understandable based on the kind of business it is. So let's go to analyst estimates. Analysts don't actually have much in terms of growth for the earnings per share. 1760 growing to 22. Not much growth over the next 3 years. Look at revenue. Not much growth here. 9%, 8.5%, 3%, 7%. But guess what? With a company with such large margins, how much margin exactly? Let's look at this. They have like an A for gross margin because it's basically all profit there, and they don't really attach a cost of goods sold. This means that, guys, they're a fee generating machine. They just generate so much in fees every single time they swipe, every single time people swipe. And this is the international high-end card. I don't think that's going away anytime soon. The question is understanding this debt right here, making sure you can understand that. Now, guys, they give out loans. That's a big chunk of their balance sheet right here. Gross loans, $219 billion. That's the assets on hand. And let's look at these liabilities. All these long-term liabilities here. What's interesting is you look at their cash and cash equivalents of $53 billion, and you look at their total current liabilities. They don't even split that up. But just look at payables, $14.7 billion. Current portion of long-term debt. Total deposits, $150 billion. That's a big part of their debt outstanding. When a bank is there and somebody puts money with them, that's essentially, they owe that money to that bank, that consumer. You put money in the bank, it's a liability for the bank. They owe you that money back. That's the way to look at it there. So let's go look at the stock analyzer tool. Let's pull up the last time I did American Express. And let's look at our assumptions here. I did 10-year analysis. First off, they have nice growing return on capital, 9% growing 11.5%. Revenue growth for the next 10 years, I put 4, 7, and 10%. I'm going to ignore profit margin because I'm really going to focus on free cash flow here. Free cash flow margin of 24, 26, and 28. And a PE and price of free cash flow, this is a premium business. It's very well known. Who's the competitor to American Express in the high-end card? I can't name one. That's what I like about them. Everybody knows you have American Express lounges. You have lounges you get into just for having an American Express. There's that elitism to it, and that is valuable. So I put in 20, 23, and 26, and my 9% desired return. I hit the analyze button. And guys, I have a low price of 480, high price of 1,078, middle price of 720. Now, where's my concern with American Express? Am I not understanding that balance sheet enough? Is it more of a bank than I'd like to admit? Is it more of a bank than Visa, MasterCard, those kind of things? These are the things that I have to understand as I try to build a position into American Express. Now, guys, if this feels overwhelming, you're not alone. At some point in every person's life who mastered this, it was overwhelming. And guess what? There's no such thing as mastering it. We're here to teach a process and a way of thinking. You're not going to agree with everything I say. That's not the point. I don't agree with everything that my best value investor friends say. But guess what? We all agree on the same general idea, and that's what we're here to do. I gave you a bunch of metrics there that are really going to apply with the next two companies. But guess what? If you don't understand those metrics, we can't really go. I want us all speaking the same language. So I made a really great cheat sheet here for you that'll give you all of these metrics in a PDF sent right to you, explains them all to you. That way we can speak the same language. And in the future, as you look at your own companies, you can pull up these metrics on the page and understand what they are. So click the link below. We will send you the key metrics PDF immediately. The second stock we're going to analyze is PayPal. PayPal also, like I said, a company that I own, is working to grow by adding smart AI tools to improve checkout and help users shop more easily online. They're building partnerships with retailers, upgrading their digital wallet, and expanding features like Venmo and Buy Now, Pay Later to boost their usage. A big part of the future is something called agentic commerce, where AI tools like ChatGPT shop for you. And PayPal wants to be the main way those purchases get paid for. Starting in 2026, PayPal will be the first payment processor to be built directly into ChatGPT, giving over 800 million users a way to buy things right inside the app using PayPal. They're also helping millions of merchants show their products to AI shoppers and are working behind the scenes to handle things like fraud protection and payments automatically. Guys, I recently bought 2 signed guitars, and the vendor who was selling it to me said, Paul, I can either do a direct payment or you can pay me 2.5% and run it through PayPal. I chose to pay 2.5% extra because I trust PayPal. That's how important to me PayPal was. I bought these 2 nice guitars, They were considerable money, so the 2.5% fee was hundreds of dollars, and that is my point. That's how much I trust PayPal. That's a big reason why I'm an investor in PayPal, as long as the price makes sense. If you had a zero to this price, and I trust them considerably, that changes my entire investment thesis. Okay, so now let's go run through this. Guys, what I love about PayPal is this. Everyone loved PayPal, everyone hates PayPal. The business is better here than it was here. That's a first fundamental thing I want you understanding. How can the business be better here than here and the stock be down? That's what investors understand. Okay, it is a $55 billion market cap, and just like American Express, has a much higher enterprise value. And just like American Express, has higher free cash flow than net income. 47% gross profit margin. That means every extra dollar they sell, 47 cents of it goes to the bottom line. Growth rate, nice growth rate. Good size acquisitions though, $6 billion in the last 5 years. So that has driven this. Our community, oh my gosh, we have 235 community members who voted on this. That puts it as a buy rating. Interesting, with an intrinsic value of 93. That's what I love about our community members. They sit there and think independently. Let's go look at these 8 pillars. 8-pillar thriller. So even with all that debt, it's only the long-term debt we include in the 8 pillars, and that's a little misleading because the total debt is what they owe to other people. Oh, and by the way, another thing, PayPal, I use it for my Airbnb business when we rent out boats and jet skis along with the houses, because I love how PayPal operates. This is something I want you guys to remember. Like, it's not, and Venmo, oh my gosh, Venmo. Is Venmo awesome or what? All right, let's go to analyst estimates. Now, analyst estimates have profit this year of $6 growing to $9.23 in the next 3 years. That's over 50% increase in the next 3 years, and revenue for this dying business of 6.8, 6.4, and 7% revenue growth. Again, we don't need to have a lot of revenue growth in order to get a good return on our investment. Bring up the example of blue chip stamps back in the 1970s that Buffett and Munger bought, made 15% of their money over a 12-year period, and revenue fell 99.9%. Fell 99.9% from the time they bought it to the time it ended. That's the key there. If you pay the right price, you can do well. So we go to Stock Analyzer tool. Let me pull up PayPal here, the last time I did it. Okay, guys, I did a 10-year analysis. I did 4, 6, and 8% revenue growth. It could be 3, 5, and 7. Actually, I'm going to change that to 3, 5, and 7. Let's go a little bit lower. Let's be a little more conservative, even though I can make that up in my desired return. Profit margin and free cash flow. Again, I'm focusing on free cash flow here. 16, 19, and 22. Now, what's the PE to apply 10 years from now? 16, 19, and 22 as well. And then my 9% market return, just to see what's the intrinsic value of the business. That's all I'm trying to find out here. I have made every possible investing mistake you can imagine. I bought too high, I sold too early, I listened to the wrong people, and that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. And boom. I have a low price of 87, high price of 200, middle price of 133 based on discounted cash flow, and based on earnings, a low price of 71, a high price of 145, middle price of 102. This is why people in our community love it. It's a company that's still growing, but the perception is it's not growing. I look at that thinking, okay. I look at PayPal and I'm like, this is a good business. People trust PayPal. That's important for me. And when it's selling for a discount, that's when it gets interesting. How much of a discount? Less than 10 times free cash flow. I like that a lot. So for a company like PayPal, I'm going to still stick with it. And at some point, as they buy back shares, earnings per share goes up, free cash flow per share goes up, the market will see the value. And by the way, about PayPal, great comment made by Tim. He uses PayPal for all his subscriptions because I said to him, you're right, because it's so easy to cancel them when I want to cancel them. He's absolutely right. All right, third company, Generac, the final stock that I own. Generac used to just focus on home generators, but now they're becoming a major energy tech company with two big growth plans. First, they're going after the booming data center market by doubling their large generator capacity and aiming to make over $500 million in revenue from that space by 2027. Second, they're working to fix and grow their clean energy segment like solar and storage by focusing on profits and cutting costs. They're also still benefiting from more power outages and weather problems, which keeps demand strong for home backup power. Analysts, who, as you know, I don't always agree with, expect Generac's earnings to grow over 15% in 2026. Don't care! With even more upside as these new strategies play out in 2027. So now, we need to run through the numbers, go through our stock analyzer tool, determine a fair price based on my assumptions that we would pay for Generac. So guys, we're looking at this company. It's a $9 billion market cap business, all-time high of 524 in 2021. So a little over 4 years ago, 52-week high of 203. I don't even know what it's at right now. Let's look. 155. Our community members have it as a hold. 52-week low of $99. Look at that fluctuation, guys. 52-week high and 52-week low. 4 months apart, 203 to 100. Are you telling me this company lost or doubled? It doubled its market cap in 4 months. Did the business really get double in 4 months? Come on, give me a break. Let's go to the 8 pillars here. All right. So we have high price of free cash flow over the last 5 years, high PE ratio over the last 5 years, higher debt levels. Okay. It is a $9 billion market cap business with $11.8 billion in enterprise value. That $2.7 billion difference is debt, which is why that's a high number. But look at this. Return on invested capital, 5 years, 9% over the last 5 years, 8% over the last 1 year. Not very good. So this is a business, even though I think they're the leader in generators, I look at that return on capital and go, I think maybe it needs a discount to value. Let's see what analysts estimate. $8.50 per share this year, going to $12.80. That's about a 50% increase in the next 3 years. And revenue growing at 11, 9, 8, and 6%. Okay, so nothing to write home about, but let's see what is going on here for Generac. So I did a 10-year analysis, 4, 6, and 8% revenue growth. I did 9.5%, 10.5%, and 11.5% profit margin, thinking their profit margin and free cash flow would increase over time, especially with this new business model they have. Now, PE and price of free cash flow. So they had 10.5% return on capital in the last 10 years, but it's declining. I'm actually going to change my mind on this 15, 18, and 21. I'm going to call it 13, 16, and 19. I'm not really feeling that. And my 9% return, I hit the analyze button. The stock's currently at 155. All right, I have a low price of 106, high price of 220, middle price of 155. So guys, I look at this going, okay, yeah, this is not making much sense to me at current prices, but I can be patient and wait for it there. So guys, the honorable mention I have is Adobe. Guys, look at this company. It just got downgraded today. It's at 305. Its all-time high on Adobe was $700 back in 2021. Since then, let's go look at the revenue. 2021, they did $16 billion in revenue. Last year, they did $23 billion, and the stock is down how much? Over half. They did profit in 2021 of $4.8 billion, $7 billion in the last 12 months. The stock is down over 50%. It just tells you that you just got to be patient for the right time to buy, okay? And let's do the stock analyzer real quick, because I just did it today on Adobe. Let's pull it up. Guys, I'm not going to tell you all my assumptions. I'm just going to show you the stock's currently at 305 and look at these values. I have a low price of 382, a high price of 820, middle price of 560. It generates more free cash flow than net income. And I think people are overplaying the whole AI issue. So guys, those 3 stocks, American Express, PayPal, Generac, plus my honorable mention. I own all 4. Don't buy them because I do, but I'm going to be selling a lot of puts on them, which allows me to buy the stocks at lower prices and get paid for it. Now, I'm not saying these are guaranteed winners. Nothing is. But if I had 30 companies like these in my portfolio, I'm probably going to do very well in the long run, as long as I can stick with owning them and let compounding take its course. Now, if you thought this breakdown was interesting, wait until you see what I did last year. I handpicked 7 stocks that I believe will actually beat the Magnificent 7 over the next 5 or 10 years. And I'm going to be honest, I was surprised by the results. You're going to want to see who made the list, so click the video on your screen right now. Thank you for your time.